Welcome to another great webinar with our friends from KPMG. I'm Johan Hispa, CEO of LandGate Corporation. Introducing my friend Nate and his colleague George. Nate, do you want to take it and introduce yourself and George?
Yeah, absolutely, Johan. Thank you to the LandGate team for hosting us again. Seems like every couple of weeks we get together, there's something new that's come down the pipe that's impacting our clients and the renewable energy markets. To that point, thrilled to have for the first time George Picoros from our energy transition team. He's my partner that leads out of the New York office, an unbelievable array of services. And as we've spoken on prior webinars, we've walked through what that scope of services is, cradle to grave for renewable energy projects. We thought it'd be good to kind of get his insight and feedback. But George, you want to properly introduce yourself, and thank you for joining us today.
Thank you, Nate, and thank you for having me here, Jan. George Pakuris. I'm leading a team within KPMG focusing on infrastructure, capital projects, and climate advisory. We're focusing on owners of four key asset classes: energy, transportation, digital infrastructure, and real estate. And we are providing a wide range of services from enterprise strategy and asset portfolio management, all the way to funding, procurement of projects, construction delivery, and M&A. So pretty wide. Personally, my background has been in energy and transportation infrastructure. And I've spent a lot of time the last few years in the energy transition space. So very happy to be here with you.
I'm actually just getting back, George. Last night, our annual Green Bond and Securitization Conference in Las Vegas, 8,000 for closest friends, investors, underwriters, and banks. And there were a handful of panels that not only was it standing room only, but we had people stacked out in behind outside the panelist rooms. And those, as you can imagine, were data center, securitization activity, what's going on with fiber optic networks, cell networks. Those markets, from a year or two ago, we were just seeing a handful of deals now, $10 to $15 billion and now a year of issuance. Everyone wants in on that game to apply debt into these projects in this booming part of the industry.
Yeah.
Well, let's get started, guys. So we had a great discussion last time, Nate, with another fantastic KPMG partner with deep insights into the political impacts on our business. And now we are 30 days in. And again, really appreciate the opportunity to have another fantastic expert, George. What has changed? So let's look at the first month of the administration and what's been an impact on renewables, EVs, energy, infrastructure, data centers, and what would be our forecast going from here?
Do you go first, or Nate, do you want to start?
I think my initial thought is everyone take a breath, right? What a 30 days it has been. Obviously, the Republicans pulled out all the stops. You almost feel like you're watching a House of Cards episode, seeing what they did to get across the House budget approval this week. But George, I think there are obviously some positive signs that the train is rolling down the tracks. I think we all knew that this process and what it's going to take to get across President Trump's desk, it's a lot of horse trading, right, to try and extend the Tax Cut and Jobs Act. We've got 10 months, so in theory, it'll be done before that. I've seen a number of different folks here in DC say it could be done as early as March, or it could spring late into the spring. George, what are kind of your thoughts and initial takeaways from our clients and conversations?
Yeah, perhaps some overarching themes first before going into the legislative process. There have been a series of executive orders, I'm sure many of you have seen them, that impact the infrastructure and energy space, and they are setting an idea about the policy priorities. And perhaps there are four 4 to 5, I would say, overarching themes before going to the details. I think the first one is there's energy dominance is definitely a priority, and that is both from a national security perspective as well as from an inflation perspective. Is something that is seen very closely. The second one is the concept that you see in several of these executive orders of consumer choice. So basically not restricting options. The third one is faster processes and accelerated delivery of the energy infrastructure. The fourth one, I would say, is more related to some skepticism and potential impact of specific clean energy technologies, but this doesn't cut across everything. And then a level of uncertainty, continued uncertainty on how some of these things will actually be implemented, right? The high level policy is there, but then how it will be implemented will take some time. And then from a, this sets the policy, as was discussed also in prior sessions. A lot of the detail is going to be negotiated in Congress, right? There is clear priority that, for example, EV mandate and goals, federal targets for EV vehicles are most likely going to be rescinded, right? They are identified specifically, but other things are more at the line item level, are more into the detail of the expectation is that will be negotiated in Congress, where you expect that there are different priorities of states and regions and industry associations will be also taken into account. And there is also an overarching thing in the whole discussion. IRA, of course, is an act that provided a lot of incentives for clean energy and infrastructure. There is an overarching theme of managing the deficit. So it is how potentially parts of the IRA may be reviewed in order to address also that overarching objective.
Yeah, and if I may jump in, Nate, and I'm not as good, obviously, a consultant as like George is, and I'd highly recommend you guys to like talk with George if you have any further question. Amazing knowledge. But the way I see it is like previous administration had like boosters and brakes at the same time, right? So they were boosting with like grants and other like fundings, but they had brakes with regulations and so I feel like this administration, you know, is like, okay, I'll get rid of a lot of the boosters and I'll get rid of the brakes too. Let's see how those vehicles are like going. And no, I'm not going to force people to take that highway. I'm going to let them take any highways they want to do, like whether it's oil and gas, whether it's like renewable energy. And I feel at this point, the renewable energy industry is strong enough that the biggest impact that has on the industry right now is actually removing those brakes, like the deregulation, and we'll talk more about that. And then the interest rates, right? And spending less, hopefully, will decrease those interest rates.
You're absolutely right. Deregulation and the changes in the permitting process are key, and a key lever that this administration will be using in order to accelerate delivery of infrastructure. It is not different in terms of of philosophy from the prior Trump administration. And it is something that, like, I've been in this industry for more than a couple of decades now. Permitting has always been an issue, and making improvements in these processes will help with the actual delivery and the cost of these projects.
Well, that's excellent. So, Nate, do you want to start talking about gas?
Yeah, I mean, I liked your analogy earlier on. I think at the end of the day, the overarching theme we're seeing and hearing is that the administration wants American energy dominance. Can't be dominant with without both sides of the coin. For a large number of transactions, and George, obviously, I'll let you take the majority of the commentary here. Natural gas is becoming a very common component in many of our new engineering and design plans. I don't think I've seen a term sheet recently with data center that doesn't have some form of gas there as a backup or key element. But it's not as if we've seen a total turn away of the renewable energy as well, right? There's still the economics. I think we've crossed the Rubicon, if you will, for a large number of clients, not just for solar, but also solar plus battery and now some geothermal transactions. So, at the end of the day, the goal is dominance, and it's to reduce energy bills. And that's going to be very tricky to do, with not a well-executed plan. And thankfully there's, enough anticipation, and we're still seeing, just talked to a client of ours who's in the tax equity brokerage business. Here in February, we're still seeing purchase of credit. So I think that's a bullish element too. George, what else do you want to dovetail there?
Yeah, I think absolutely. Oil and gas investment in exploration, production, transportation is going to be critical. There is, you see also, many of the large oil and gas companies have announced increases in oil production, both in the US and abroad, like BP, Chevron, Exxon. Although Chevron, there was yesterday an announcement about the impact on the exploration in Venezuela and production. But of course, there are also other sources that they will be focusing on. The second theme I would say is more about exports, especially LNG exports. You had approvals after many years of an export facility, the Commonwealth one, following the pause under Biden administration. You have invitations for looking again into pipelines like the Keystone pipeline. So there is a lot of focus in this space. And perhaps something that is close to oil and gas, not exactly oil and gas. There is also discussion on biofuels and like things like renewable diesel, aviation fuels that may also be needed because of European regulation. You have the approval under the new administration of a loan, DOE loan for a aviation fuel facility and renewable diesel facility. So there is focusing on that part of the market as well. And then, Nate, you mentioned data centers, which is, I don't think there is a day that I don't have a discussion about data centers. I come more from the energy perspective, but the technology firms are a big driver here. So clearly this administration is prioritizing investment in AI infrastructure and data centers, and energy is a key component of it. Natural gas is considered the bridge here to also other more long-term and more sustainable solutions. You have a lot of investment behind the meter that is being planned. You have several of the big tech companies signing PPAs, like with Constellation and Talent, on nuclear energy supply for data centers. You have some discussions in some places, even repowering coal plants in order, again, to advance some things quickly. And there are still discussions. I mean, renewable is part of the mix. There's so much demand that you cannot take off the table renewable options as well. But of course, they will need their backup plans, etc. One area that we are looking closely to is SMRs. There are some agreements from tech companies into this space for development of SMRs. There are several utilities that are advancing such plans. They haven't progressed a lot yet. The key question mark there is how changes in the permitting process are going to allow for the acceleration of these investments. Although the SMRs are smaller investments compared to the more traditional nuclear plants that were built in the past, the permitting process is pretty similar. So if that is accelerated, then it can help advancing the investments.
That's excellent. And I'm sorry, I put that like as soon as you start talking about data centers, just wanted to show like so on the platform, LandGate platform, all the oil and gas wells. So one of the few platforms that has all the oil and gas wells, including forecast, oil and gas production, everything. And you see a data center right there, smacked in the middle of all these oil and gas fields. And what we're seeing more and more is those data centers looking for power. Where can I get the cheapest, most accessible, most direct power? I'm going to bypass everything. They want to bypass the grid. They want to bypass they want to go straight to the gas well at this point and get their power right there. Like I'm going to plug my generator right to that gas well and get my data center going. So you can see a lot of that. Let me click on that gas well. And you see the production generation of production. And quite interesting. Any comment on that, Nate?
Yeah, I mean, I think when we see, and we love the tools, right? It's always been an important part for our team. We're on the site selection team as well. We've had Ulrich and his team join us in the past. Power usage effectiveness is a real important consideration in our transactions with Wall Street and applying capital market debt. If the economy grew, I think GDP was up 2.8%. Consumption is up a little less than 1% of energy. And so it means our energy efficiency is growing. But the question is, I mean, George, back to you. If you look at the big four pillars of what's driving load growth, right? Data centers, manufacturing boom, electrification, and then obviously the big X factor is AI applications. I've seen some pundits and some of the think tanks say that electricity growth could be 8 to 12%. Like at some point, even if we're getting 50 gigawatts a year of just solar alone, which was last year, we just can't keep up, right? At some point, our energy needs in the grid and specifically our T&D network is going to buckle.
Yeah, definitely the projection is for substantial increase in power generation. There are also like high-level policy goals in that space, but perhaps one of the key indicators is the share prices of utility companies, which a few years ago nobody would have expected that they are growth stocks, but they are growing at much higher rates the last couple of years, and of course they have a lot of capital deployment needs in the coming years in order to support all that expected demand. Of course, everything will be done in a stepwise manner, but the expectation is that demand will continue.
And I think, George, to wrap a bow on it, the administration has said clearly they want to decrease electricity prices and bills for homeowners. But the problem is that's going to be a very difficult, element, because we've seen some projections that say, we saw a MISO utility said, rates could increase 13 to 15% if nothing changes, right? Interest rates are high. There's been a freeze, as we know, on some of the Department of Energy's larger investments and grant program. Any insights there into how we can meet all this growing demand, but without necessarily have it hit our homeowner, or our corporate bottom line and utility bill paying?
Yeah, this is the projections right now, and these were even before the new administration, is that at least for the next 1 or 2 years, it's probable that electricity prices will be going up because the cost of production went up and the cost of capital went up. So both of these are contributing, and I think increase in supply will be a major driver here about how quickly it can be done. Like of course there are areas that can impact faster, but also there is also new investment that will take some time in order to start impacting the supply.
Foreign investments in U.S. manufacturing, tariffs.
Yeah, hard not to across Georgia, Tennessee, and so many of our other clients and states. The manufacturing boom, the amount of money that's been invested is truly remarkable. So the comment that I've heard, George, from a number of our clients is that the administration has to be careful that they don't derail the train that's already rolling, right? How do we ensure, right, that we continue to attract these investment dollars and keep the technology here on our shores, especially in the battery storage area? I don't know what your immediate thoughts are there as well.
Yeah, I think, this is important. This aspect is important because it impacts the supply chain, basically, of delivery of infrastructure, of energy infrastructure and energy services. There is definitely an interest in attracting even more investment in U.S. manufacturing and that supply chain. What is impacting right now the market is because one of the main tools, of course, there will be others as well, that is currently is discussed, is tariffs, right? Because if you increase tariffs for imports, then you are incentivizing more production in the U.S. But it is also right now is being used as a tool for negotiations with different countries. So it is not exactly certain where it's going to land. We see a lot of interest from foreign investors, especially from Asia, in building further supply chain and manufacturing in the US. But also some of them are careful until they see a little bit more where the whole thing lands in the coming months. And this is about batteries, other supply chain related to EVs. It's about different commodities. It is also about even steel.
One of the anecdotes that jumps out at me, Johan, is we've seen some of our utility clients that were looking at 1 year supply chain delays for transformers, especially some of the larger ones, to now we're up to 2 years. So that's why there's an increased investor and engineering push to protect transformers and asset management, because they're such a critical part of this equation. And every time you read in the news, there's just another large one, Excel Energy, a transformer fire and that equipment being destroyed, right? That's just another chink in the armor here, what we have here domestically in our infrastructure.
Yeah, I think we're seeing for sure a huge increase, like we're talking about electricity demand, right? So the infrastructure is going to keep growing, and then you can see I'm showing proposed substations, additional infrastructure network that's going to keep increasing. It can be affected by some of the tariffs, and because that inflation we're fighting. So we're seeing that, and this is by the way, brand new data sets, proposed electric substations, and alongside the proposed transmission lines that you can see. So very important data sets there. But then, like, I'm curious, like, what you guys think when. So again, we're removing the boosters and the brakes, and we're not forcing people to use certain lanes. Well, how is it going to affect? So electricity, high demand. Now you have different ways to produce electricity, right? And the electricity price is going up. Well, that's actually not bad because it's going to help the renewable energy developers using solar and it's going to help them a lot to have higher prices of electricity. And are they at the point where that's going to be sufficient to keep pressing forward and compete with other ways of generating electricity? Any thoughts?
I think perhaps I will make an overarching comment that there is so much demand right now that you cannot take off the table any of the tools you have and any of the different technologies you have. Of course, depending on the situation, the affordability of the investment, the price under a PPA, all these will be taken into account. But there will be also the right projects that the renewable technology is the right one.
Right. I mean, the deregulation, what I call like removing the brakes, that's going to lower the cost quite a bit.
Yeah.
And I think we published an article that showed that not comparing administrations, but during the deregulation times, actually in the first Trump administration, well, the stocks of all the EV renewable type ETFs grew a lot because of that deregulation. That had a very positive impact. So it lowered the costs. And if you see lowered costs increase electricity prices, that's going to be good enough there. And if you add a little bit of lower interest rates to that equation, that might provide a very, very good recipe. And George, I think it's a very good point that I think we saw it as initially, or it felt like you got to use that lane to generate electricity. But at this point, it's like, guys, the demand is so large. There's such a high demand from data centers. Just remove those like mandates and make it like use any lanes, because even using all of that, we don't even know if the prices of electricity will remain within a tolerable range, right?
Yeah.
So,
and the other thing is that nuclear that is a source or a technology that can bring substantial incremental capacity into the system is not something that at the end of the day will be done quickly. It will take time. So there will be need for all the other sources and technologies in order to address demand.
yeah, no, absolutely.
I think there's also an element, John, too. I could keep talking about the demand, but on the supply side, something was at this conference brought up by a number of our banks is climate impact, right? You look at the size, the scale, the impact of these storms. It's in Carolina or California and Texas every February. There's an element too where the utilities have to adjust, George, right? Like we've seen a significant boom in client activity in around microgrids and putting other DERs in place that help provide pockets of support. Virtual power plant securitization is an element. The rating agencies have been engaging KPMG for methodology assistance. I think there's an element of it's going to take a whole variety of elements, right? This isn't just, hey, can we keep the cost of power low? It's how do we keep the light on some of these unbelievable storms we've just never seen before.
Yeah, they are deep. There are several. You're right. There are several other drivers. It's not just the energy supply component, right, that create demand for different players in the market. One is wildfires are in many places of this country, right? And it is a real issue. So substantial investment is going into this, and even more will go in the coming years, especially with undergrounding of cables and such type of projects. And then you have the grid is old, right? And it's not efficient. And you have also the distributed solar capacity. So different technologies that are helping also with making the grid more efficient, like virtual power plants. Are things that will continue being in demand. Is my expectation.
So what I'm reading from that, I think some people pessimistic might read like, oh, there's no more like climate concern driving policies. But I think what I'm reading is the federal government will not drive those policies, but they'll be like up to the states and up to the local authorities and to what you guys said, utilities and the market itself to drive those policies and to assess the risks from a market standpoint, right?
Yeah, no, you're absolutely right, because of course the federal government sets energy policy. They have more levers when things are in federal lands or federal waters, or if there is environmental regulation in relation to this. For example, offshore wind is impacted because many of the leases are in federal waters. You can impact more the increase in production of oil and gas because a lot of that is in federal lands and waters. But they are also part of this market that are impacted by state regulation, by needs of specific utilities. So there are multiple drivers there that will help advance this market.
Well, let's talk. You guys want to touch a little bit on them? So since we talked about like having a lot more drivers from local and private, right? That would drive like all those needs for climate and that will impact the costs. Like, what's your take on energy communities and the continued impact of the energy communities into prices, development?
Perhaps I'm not well positioned to answer that, Nate. I don't know if you have any thoughts on this.
Yeah, I mean, I'll be honest. It's obviously a big consideration on the adders, but I think, Johan, we're seeing a lot more activity and client pressures on the domestic manufacturing side of things. SEIA just put out a report the other day that we've now got 24 large-scale solar production facilities in the U.S. We've increased U.S. Domestic manufacturing the past 40 gigawatts now, which is pretty impressive. I think that's probably the bigger story, that the element is, the administration in our country wants our cake and eat it too. We want to be able to get as much power as we can. To George's earlier point, we want to be able to export it, reap those financial benefits, but also maintain that momentum we have of domestic manufacturing, right? American energy dominance is, what I hear probably just as much as data center, right, world these days, and digital infrastructure spend. I think a large part of that, George, is to thank because of the DOE's work, investments on both sides of the aisle, right? This is money that's gone to both Democrat and Republican parts of the country. But I think that's really like the story here, is that how do we maintain, in a big construct where KPMGs, we've spoken about this in the past, prevailing wage, apprenticeship, compliance, making sure these are well-paying jobs that feed into, right, not just our wealthy communities, but also those, poor parts and those parts of the country that need the economic boost.
Yeah, and
I mean, it's the.
Sorry, please go ahead.
Oh, I was about to jump, John, for a second on the dominance that Nate is talking about from a energy dominance. But what I'm seeing also is like a AI dominance, where the United States has like over 10 times more data centers than the next one, the next country there, Germany. So over like 5,500 data centers, Germany has like 500. So you take all the top 10, the US has like much more than anyone out there in terms of data centers. So that AI infrastructure dominance, AI dominance that requires an infrastructure, that requires a lot of energy. So it's not just like energy dominance in terms of like I'm a net exporter of oil and gas, and I'm continuing to keep up with the demand of electricity with the growing population. No, I need to keep up with the huge demand from like what will probably be like a number one like industry in the US in a decade.
Yeah, I think you're hitting the nail on the head from the perspective that energy and technology are two areas where the US is very strong, is number one in the world, right? And what is happening right now, these things are coming together because of the AI revolution as well. And it creates different types of opportunities. And perhaps on the exports, maybe more on the oil and gas space. When you look into on the AI side, maybe more the power markets, right? And then investment more there in order to help advance it more.
I think that's one of the nice elements I've seen in smooth transition. You know, Trump and David Sachs, the AI czar, clearly said they really liked what Biden had set up to use federal lands. We're very blessed in this country to have that availability, to have that to expand, to put these centers. And George, back to your comment on SMRs, to be able to put data centers in parts of the country that aren't in any type of, you know, urban area, right? To give them a buffer of sorts. I think that's something that we're you know, as a country, we're fortunate to have, and mapping and spatial tools, right? With LandGate, and I think there's a great opportunity to continue placing and finding the right spots along with the infrastructure that's needed too. Sure, certainly makes the insurance companies happier when citing and determining premiums, right, for those big data centers and their, you know, electrical grid commitment.
Yeah, absolutely. It's exciting to see like the development of data centers and especially when you see the activity of the planned data centers in the US proposed and huge amount, and who's the most active out there, and I think it's going to be amazing to watch that. Not on my electricity bill though. It's not going to be that amazing to watch that.
I'll give you a quick anecdote from the field. We just did a due diligence trip for one of our clients. The construction company invited us out. Just a remarkable build. So we got to put on hard hat and got to walk out inside the sites, walk the data halls. This specific one here in Loudoun County is being built to a power usage effectiveness quotient of 1.2, right? Which is just an unbelievable achievement, considering in the early days of finance, right, you could be as high as a use effective 2. Now we're down to 1.5. We're now seeing EPC firms and we're seeing financial incentives from the banks that help the construction finance, the advisory reward those better builds, right? I mean, George, it's just remarkable what we're seeing in recapture technologies for heat recovery and being able to do direct chip cooling, reducing the amount of fans you've got to push across, you know, football fields and football fields of server racks.
Yeah, and also we are talking about oil and gas, we're talking about renewables, but overall, my perspective is that there is interest in overall advancing energy technologies, because again, this is an area that there is global competition, and not falling back on these more newer areas is important. There are just some. There will be just some more. Let's say thinking on how the federal government may be funding new technologies versus letting the private markets more fund more established technologies. So money is allocated in a more efficient way.
Great. Nate, what's next? Do you want to talk more about EV mandates, incentives?
Yeah, the $5 billion NEVI program. George, did you want to touch on this? Kind of what we've seen there in the last couple of weeks. Not all positive.
I think they, again, here is some of the funding that is coming from the federal government. The expectation is that will slow down, and then is the targets that the federal administration may have for their own purchases also most probably will not in place anymore. It's this has been very specifically identified in the executive order, so I think it is something that will be definitely impacted is what we see. Now, on the other side, to make it clear, we talked about customer choice, right? So it's not preventing EV penetration, but it's more not providing subsidies for EVs. There is a lot of discussion that we didn't talk earlier about critical minerals. Some of it is also for batteries that go into electric vehicles. So it is support of the industry, but removing subsidies.
I'm going to throw that curveball, guys. And I don't mean it in any bad political way. And I heard you, George, saying there's just a lot of negotiation out there. But when you see the administration negotiating for 50% of the critical and rare earth minerals from Ukraine, and you see that 70% of those minerals are lithium, used mainly for batteries, meaning EVs. Well, how much do you think the administration is actually seeing value in those EVs, right? Because there's a double communication there. One saying well, we don't really need to push EVs as hard, but then the facts looks like they are recognizing EV as the future and trying to secure at the same time minerals for those EVs.
Yeah, it is a little bit, from one hand, in my mind, not picking winners and losers by using subsidies from one hand, but on the other hand, making sure that you secure the supply chains that you need in order to stay competitive, right? Because right now, a lot of these critical minerals are imported. If you don't secure those supply chains, that industry, which you would want to grow as well, right? And there is a global market, will be impacted. So it's a little bit like we discussed earlier about using different levers in order to advance policy, right? Using less subsidies, we said earlier, right? Using less subsidies, improving the permitting process. Here is less subsidies, but securing the critical minerals that you need. Mm-hmm. And of course, the critical minerals are needed in other parts of the economy as well, but absolutely in the EV space, they are important.
I think there's a question from Diana. Nate, do you want to go over that question?
I don't know if I'm actually seeing that one, Johan. Is that
I think I've seen
the one you can read out?
Give me a second. Maybe I misread that one. So I'll try to find it. We can keep going. Sure. I'll try to find it.
Well, I think just to put a bow on the NEVI news, just like we saw in Trump 1.0 administration, what it does is it puts the ball back in the court of the states, right? So we've seen a significant number of states that have made commitments that they'll pick up the funding, right? That's a big part of the federal push is let the states determine and decide where they want to spend their dollars. they've got to remain on budgets. So, we've seen some interesting announcements where states have stood up and said, we still plan to cover those stations. And, to John Gimiglione's point a couple of weeks ago now, we knew that there was going to be an Elon Musk impact, right? His supercharger network and other networks that are out there, it, has tilted the field in certain favor there. But we still continue to see a strong growth amongst EV sales and adoption rates, right? Personally speaking, here in our neighborhood, with the number of folks, my parents included, have loved their switch to an EV, and they plan to stay with it, right? It's not a game changer as to how the network would charge or change.
Yeah, and I think, Diane, I saw you raise a hand there. If you want to put your question in the Q&A, then we'll share it with the audience. I'd love to hear. And anyone has any questions, by all means, like put them in the Q&A chat, and then we'll read them out loud and talk to them. Really appreciate everyone's contribution.
So, George, I know we spent a lot of our time in federal funding and grant world. Do you want to kind of talk about what you've seen with this theme of the change administration, and then I can end at the back with what we've seen like in the asset-backed market for these deals?
Yeah, perhaps some insights from the market. There is continued activity in the renewables markets, especially in relation to tax equity deals. They are advancing. You see, of course, a little bit some of the tax equity being committed later in the process that could create some heartburn to some of the banks, but there is continuation. And then there is an expectation that even if some things are, some incentives are reduced in size, etc., there will be transition periods, etc. Overall, I hear a lot of excitement about the deregulation and the approval of permitting processes, especially on the developer side. There is focus on markets where also state policies may be driving continued demand. You see a lot of repowering because some of these also deals can move faster. And also a lot of interest, as I mentioned earlier, increasing interest for more investment in U.S. supply chain and manufacturing. But as I mentioned earlier, that some of that capital will perhaps wait a little bit to get some more certainty on some of the trade policies. So overall, although there is a level of concern about specific technologies that may be impacted to some extent, and there is a negotiation that will take place ahead of us in order, like specific line items to be addressed, there is overall positivity from the perspective that there is substantial energy demand that will keep driving this market. And there is also a regulatory framework that can help us deliver that work faster.
I liked your comment, George, on repowering. I think in the absence of as fast as we'd seen for growth in greenfield projects, Rocco De Bruno, who we've had on before in prior webinars, tells me that he just can't keep up with the unbelievable demand that they're getting for their appraisal and fair market value step-up analysis, repowering not just wind and solar, but hydroelectric projects. Those have been a big boom in the market. And a nice part of that, back to the state comment I made earlier, is a number of states provide strong incentives, right? NYSERDA has been leading the pack. We've seen a couple of other states that will provide, significant boom to your ROI if you ensure that you're basically investing enough. There are 80-20 rules, a good example, that repowering is substantial, right? And that you're really adding those additional, and it's also a greenhouse gas friendly way, right? Not having to pour new concrete or having to go source steel, right? You already have a lot of this equipment there on site, there in your acreage.
I just want to show that from a deregulation standpoint, jumping on that. Again, I don't mean that any politically, but deregulations do seem to have an impact, and just picked up like three big ETFs for renewables and EVs types, so ICLN, PBW, TAN. You can see what the impact of deregulation was. I know that was not the only impact. There were interest rates and other things. But overall, I think we're going to be like, it's going to be really good for the industry to see those deregulations, removing the brakes, adjustment of the prices to where they should be, and putting us in a good spot after that. Long term, enabling all type of energies to contribute to the huge demand of electricity that we have in the US. I would really encourage you guys to like reach out to Nate and the KPMG team. They are like fantastic in all the work they do, advisory, consulting for PPA, valuation work, improving the balance sheet, right? You have a high interest rates environment. You need to improve your balance sheet and find value with the land that you actually leased yourself for solar projects. They can do that. I've seen them doing that. It's been like amazing work. And tax credit structuring, PPAs. Nate, do you want to talk to that?
Sure. I mean, it actually make more sense. I mean, George, as our energy transition leader, I think our collaborative group here really has kind of found a sweet spot that, cradle to grave, right? We kind of have the bases covered.
Yeah, to a large extent, we want to be helpful with with our clients from help thinking of how to approach a project or a problem, all the way to how you are going to fund it more efficiently, how you can restructure your balance sheet, how you can negotiate PPAs, how you can more efficiently deliver your projects. So it is a wide range of services. I don't want to get into too much detail because there are so many different things. Our priority is to address the needs of our clients, and we're very happy to have also offline discussions to discuss with you about any challenges you are facing and provide perspectives on how they can be addressed.
Excellent.
And we appreciate, we were just on a call with your engineers team last week saying, hey, how can we improve some of the visualizations for repowering, specifically on hydroelectric projects that may be good candidates, right? So Alliance has been a good one and mutually beneficial. Thank you.
No, you're welcome. And then yeah, we love hearing from clients and how we can do better. And I know we've heard about also like the big interest, as I showed you on connecting data centers to gas wells, and now we're going to present we're going to turn the forecast of the remaining gas production of all the wells in the US, which we have. We're going to turn that into a megawatt type data set, just to present that to the data center developers, saying, well, this is where you can access more power as well, if you need to. So again, these ways to contact LandGate, energy@landgate.com. That was energy@landgate.com. And KPMG, you see George and Nate, contact details. Has there been any questions from the audience that you've seen, Nate?
Not that I've seen
Q&A?
pop up.
No? All right, very good. Well, excellent. Thank you all. We appreciate your time and look forward to the next webinar from LandGate. Hi.
Thanks
Bye
for
all.
having us, John.
Thank you.